Hello, Business 202. This Google Hangout is to describe the topic of cost volume profit analysis from Chapter 21. What we are doing in Chapter 21 is shifting gears a little bit from the debits and credits and the accounts that were described in Chapters 18, 19, 20, in the previous set of managerial accounting chapters, and we're moving toward pure decision-making type of information. This is the type of on-demand, as-needed information that a business manager would want, and where this fits into the business planning phase is that it happens at the beginning of the year before operations actually take place. There is no need to do debits and credits or make recording of the information that's created in Chapter 21 because it is a plan. It's a way to see what resources, personnel, and financing might be needed to start the operations for the particular year. With that said, let's take a look at what's going on. The topic that starts this chapter is cost behavior. And in a very broad sense, there are two types of costs that this chapter deals with. Variable costs, those costs that are driven by some type of activity, whether it's the number of parts made or the number of hours worked, and fixed costs, those costs that do not respond or are not driven by activity. Fixed costs are fixed in time, and an example of those would be depreciation, which is a cost that's done based on the passage of time. Insurance, you buy insurance for a 6-month or 1-year period, or let's say advertising contracts. You might advertise a particular product and have a 6-month span that you want to advertise this material or this product in. So the idea, in a very broad sense, is that managers make decisions about two broad things. One, managers make decisions about the level of activity. The level of activity will influence the up and down movement of variable costs. The second broad type of decision that managers make is about time. The length of time a certain commitment will last. For example, if a manager buys a machine, that machine will be with the business, let's say, for the 5 years that that machine has a duty cycle. So the business is committed to servicing and caring for this machine over this 5-year period, and the business must account for that cost over the 5-year period, regardless if it makes no products or if it makes thousands of products using that particular machine. A mixed cost is a cost that has characteristics of both variable and fixed costs. So the best example of that might be your phone bill. You know, with your particular phone bill, you're having a flat rate of $50 a month to make a certain number of text, calls, data usage. But if you go over that data usage limit, you are charged additional cost per minute. That is known as a mixed cost. The fixed cost portion represents the usage up to the certain cap. The variable portion kicks in once you go over that cap and begin incurring charges based on the number of minutes that you use. Okay, so just to review, variable costs are driven by activity and are influenced by decisions made about the activity. Fixed costs are influenced by time and are not influenced by the level of activity. Okay, so what about the cost behavior concepts? What's important here? What you may want to do at this point is to stop the video and print out the course outline that's available on Google Drive and open your books to page 991, which is the illustrative problem that we will be using during this Google Hangout. Okay, so what are the good takeaway points from cost behavior for variable costs and fixed costs? Well, variable costs, if you were to compare them on a total basis to a per unit basis, variable costs will increase in a straight line over the relevant range as volume increases. The vertical axis represents dollars of costs. The horizontal axis represents the volume of activity. So as you increase the volume of the number of items that are being produced, variable costs will go up at a 45-degree angle as that production increases. But if we would take the variable cost total and divide it by the number of units produced, so for example, at 10,000 units produced, the variable cost is $100,000. Taking the total variable cost divided by the number of units produced, you get $10 per unit. As we would increase to 20,000 units, going up here to 20,000 units, we see that we incur $200,000 of total costs. $200,000 of total costs divided by 20,000 units, okay, fixed costs per unit stay the same. So regardless of the volume that we produced, the unit cost for variable cost stay the same. That's useful for planning purposes because regardless of the number of units that are made, variable cost per unit will be the same. Now let's contrast that to fixed costs. Fixed costs are fixed with regard to the number of units made. And so you can see whether this particular business produces 100,000, 200,000, or 300,000 units, the total fixed costs remain the same at $75,000. Now this has a unique characteristic when we consider this on a per unit basis. If we would consider the the fixed costs at $100,000 or unit volume, 100,000 divided by $75,000 of cost would give 75 cents as the cost per unit. But as the number of units produced increases, well, that fixed cost can be shared by the higher number of units. So as we would increase, let's say, to 200,000 into 75 cents, that means the variable cost per unit would only be about 37.5 cents for each of those units. And if we would ramp up our production to 300,000, which would share that $75,000 of cost, our per unit cost would only be about 25 cents per unit. So the takeaway point from 21.1b is that as volume increases, the fixed cost per unit will decrease. Here is my point on this. It is never a good idea for decision purposes to unitize a fixed cost or to consider a fixed cost per unit. It's always better for decisions to consider fixed costs in total. Let me say that again. It's not such a good idea to unitize fixed costs. It's a better idea for decisions to consider fixed costs in total. Why? Well, fixed costs are made regarding decisions about time, or they are controlled about making decisions about time, whereas variable costs are controlled by making decisions about activity. I'll say that one again. Fixed costs are controlled by managers making decisions about the time that the fixed costs will exist. Variable costs are controlled with managers making decisions about the level of activity that applies in the manufacturing process. Okay, with that very important point in mind, let's take a look at one of the tools that cost volume profit analysis will use. And that's this item that you see right here. This is a contribution margin format income statement. This contribution format income statement is an internal use document only and will not be published as part of the annual report that generally accepted accounting principles require for annual reports that go to outside investors. This is used exclusively by managers and not reported to the outside. How this is arranged is in a cost behavior format, meaning that all the variable costs for manufacturing only are shown as a deduction from sales, and all the fixed costs are treated in total. We have a new term here known as contribution margin. Contribution margin is the sales less total variable costs of manufacturing to give this item called contribution margin. As you can see, the contribution margin is highlighted, and there's a strong arrow here pointing to it. So that is the key that we want to work toward with all the exercises that we have with CVP analysis. Contribution margin represents the dollars of sales left over after covering the variable cost of manufacturer to contribute to covering fixed costs and any other costs associated with the business, like selling, general, and administrative costs and interest. Okay, so let's examine this contribution format a little bit more. And just as a side item, you won't find this description in your textbook because it's something that I give in addition to the textbook, because the mathematical approach that the book explains in section 21.3 gives you the idea that you have to memorize a formula. I hate memorizing, and I don't like using formulas because they don't always fit. But what this contribution format analysis does is to fit all the problems that you can do. And here's the key. If you would track the total dollars of sales, variable costs, and contribution margin, the per unit amounts for sales, variable costs, and contribution margin, and the percent relationships for sales, which is always 100%, variable costs as a percent of sales, and contribution margin as a percent of sales, you will be able to calculate answers for all the problems that you have in this particular chapter. Okay, so since this is the highlight of this particular video, and I think it's a good idea for you to use this idea for all the problems that we have, let's just illustrate its use by taking a look at the illustrative problem in your chapter that begins on page 991. So turn to page 991 to the illustrative problem, and let's see if we can use the contribution format income statement to solve some of the items that you have here. So to review the problem, we have a company, Wyatt Inc., and let's say that Wyatt is a manufacturer. It expects to maintain the same inventory levels at the beginning of the year as it does at the end of the year. Now, this is a simplifying assumption that this particular chapter makes in all the exercises that it presents, and it's a simplifying assumption that I will make when I design any of your exams. Inventories for work in process and finished goods will not change during the year so that it doesn't add complexity to the cost volume profit analysis. Now, Wyatt Inc. estimates that its fixed cost for the year will be $288,000 and that it estimates the variable cost per unit at $14 per unit. It is expected that 60,000 units will be sold at a price of $20 a unit, and the Wyatt Company in its relevant range where all these cost volume profit relationships hold constant is at most 70,000 units. If the company goes above 70,000 units, it's going to run into a different layer of costs that are the factory to handle this higher volume. So we are going to work within the relevant range to 70,000. And something that I've added to do a little bit of extra work is let's assume that the Wyatt Company experiences an income tax rate of 40%. So what we want to be able to do at the beginning of the period is to determine how many units the Wyatt Company needs to sell in order to break even. Okay, so let's examine this particular scenario using the contribution margin format income statement. Here's the trick. review the problem, and then complete as best as you can the information for total dollars, per unit amounts, and percentage relationships, and then go about what you need to do to calculate this contribution margin. The contribution margin is the item that's going to be the key to all of the exercises, because you need a minimum contribution margin to cover fixed costs and any OINC, operating income, that's necessary to cover selling, general, administrative, interest, and tax expenses. Okay, so let's put some of the information from the problem. First item is that we have fixed costs at $288,000. And remember, for fixed costs, it's always a bad idea to unitize fixed costs, never calculate a fixed cost per unit, but always treat fixed costs in total, because they are controlled by managers' decisions about time. Second item is that we have variable manufacturing cost per unit of $14. So we will enter 14 under the per unit column. And it is expected that the company will sell in the coming year 60,000 units at a price of $20 per unit. So the selling price per unit will be $20. And the other information won't be necessary until later on. So with these three items that we've put on the schedule, we should be able to calculate the break-even. Okay, so what is break-even? Break-even is the point where the company will have zero income. It neither has a profit or neither has a loss, and that's where operating income will be zero. Here's the key. What we want to do is to start with our target profit, which in this case is zero, and work up the contribution format income statement to determine the minimum contribution margin that we need to arrive at our target profit. Let me say that again. The trick is to work up the income statement to find the minimum contribution margin that's necessary to arrive at the target profit, which in this problem is zero. Okay, so if we want zero profit and we add $288,000 of fixed costs, that means that the contribution margin must be operating profit plus fixed costs, or $288,000 at a minimum, in order to break even. Okay, now let's work on the per unit amounts. Excuse me. If each unit that we sells for $20 and it costs the business $14 to make each one of those units, that means that the company, for every unit that it sells, has a contribution margin of 20 minus 14, or $6. That means every unit sold adds $6 to covering this contribution margin. So the question becomes, what is the break-even point in sales? Okay, well, if we need a total of $288,000 and each unit that we make contributes $6 towards that goal, $6 per unit divided into $288,000 as our target contribution margin should give us the number of units that we need to sell. So let's calculate the break-even units. Break-even units will be the target contribution margin divided by the unit contribution margin, which in this case would be $288,000 divided by $6. And taking $288,000 and dividing it by $6, that means that we would get 48,000 units as what's necessary to break even. Okay, now it would be very useful for this particular scenario to be able to check it. Well, let's just take this 48,000 and insert it into the total column for the income statement. Okay, so for each of these 48,000 units, we would be able to sell them for $20. So 20 times 48,000 will produce $960,000 in sales. So let's enter 960 in the income statement as sales. It costs the company $14 for each of those 48,000 units. So let's multiply $14 per unit as the manufacturing cost times the 48,000 that would have been sold. So 48,000 times 14 will give 672,000 as the variable manufacturing costs. Now let's check to see if we can also arrive in a top-down fashion the same 288,000. So 960,000 of sales less $672,000 of variable costs. Okay, that does in fact produce the same $288,000 in contribution margin, so we must have calculated the break-even point correctly. Because if we attain $288,000 of contribution margin and then cover the $288,000 of fixed costs, we will arrive at the zero break-even point. Okay? All right, so that takes care of item 1, calculating break-even point in units. Now, let's add one more thing to this. Let's also calculate the break-even point in terms of sales dollars. Well, you can see that we have already done that, because if we can calculate the 48,000 units to break even, and if we multiply that by the $20 per unit, we will arrive at $960,000 as the sales dollars. So $960,000 is the answer to that. But let me add one more little trick to that. You can use this third column, the percent column, to figure total dollar sales without the necessity of calculating the number of units first. Let's just do that to illustrate the concept. The point of the percent is to show all the dollar amounts and per unit amounts as a percent of sales. So each of these values will be a vertical analysis where sales represents 100%. Let's make variable cost as a percent of sales. So 14 divided by 20 means that the variable cost would be 70% of sales, and the variable costs less the fixed costs gives us $6 as a contribution margin per unit. So 6 divided by 20, that will give us 30% as the variable cost percentage. Okay, so let's use that information to calculate the break-even sales dollars. That would be the target contribution margin divided by the contribution margin percent, also known as the contribution margin ratio. The target contribution margin, as you see, is 288,000, and we want to divide it by the 30% contribution margin ratio. So 288,000 times 30%, well, that does in fact give us the same $960,000 of sales that we had calculated earlier. Okay? All right, that takes care of illustration number 1, how to determine the break-even point in sales and the break-even point in sales dollars. Let's take a look at number 2. Item number 2 asks, okay, we want to do better than just break even. This company wants to make income. And so what would we do to make an income of $48,000? Well, let's use the same information, but change this total column. So I will erase some of the results that we had before, which represented our planning, and set up a new plan. What we want to do is the same type of issue. We want to work toward the contribution margin. We want to find the minimum contribution margin that will allow us to cover fixed costs and operating income. In this case, the operating income target is $48,000. We know the company has to cover $288,000 of fixed costs, so adding together $48,000 of profit and $288,000 of fixed cost will give us $336,000 as the target contribution margin that we have to achieve. The relationships on the per unit basis and the percentage basis, regardless of the number of units that are made or sold, will always stay the same with variable costs. So we can use the information in columns 2 and 3 from problem number 1. So let's calculate the break-even units. Break-even units will equal the target contribution margin divided by the unit contribution margin. Target contribution margin is $336,000 and the unit contribution margin is $6. So $336,000 divided by 6 means that the business should make or sell 56,000 units in order to attain a target profit of 56,000 units. Let's check it to make sure that this makes sense. 56,000 units as the target times $20 per unit means that total dollar sales for this company must be $1,120,000. The variable costs would be $14 per unit times 56,000 units, or $784,000. Now let's check. Let's take the sales of $1,120,000 and deduct the variable costs of $784,000, and when we do that, we can see in fact that $36,000. Okay, so that takes care of the second item that we want to go over, calculating a target profit using the same type of cost volume profit approach. Now let's go one step further and add a little bit of complexity to this illustration by adding in Uncle Sam and income taxes. The note to take and the issue to remember about income taxes is that income taxes work and behave like a variable cost. So we want to treat income taxes as if it were a variable cost, and income taxes would be used like a percentage relationship that we have in this third column. So let's adjust the information that we have for the third scenario for income taxes. So removing the items that we had before, and let's extend this illustration a bit by adding a line for income taxes. And after we subtract income taxes from the profit before tax, that should give us the net income. And I will illustrate income with the Greek symbol pi to indicate that, well, we all want a bigger piece of the income pie. The process is the same as we had before. What we want to do is to work toward the target contribution margin that allows us to achieve, in this case, a target income of $36,000. So let's pencil in the target net income of $36,000. Okay, here is how an income tax expense operates as a variable cost. We will say that the operating income, or profit before tax, I can abbreviate operating income, PBT in this case, as a profit before tax, and let's assume that there is no interest or other gains and losses that we need to consider in this particular case. Operating income would be 100%. Taxes, as your problem illustrates, would be 40%. So that leaves net income to be 60% of the profit before tax. In other words, whatever value that we calculate as the income before tax times 60% will give us the profit after tax. So how do you get the profit before tax? Well, this number divided by 60% should give us the target income before tax. Let's try that. Let's take the $36,000 and divide it by 60%, and that produces $60,000 as the profit before tax. How much tax do we pay on $60,000? Well, it would be 40%. 40% times 60,000 would give you 48,000. And if we would take 60,000 and deduct $48,000 in taxes, okay, that doesn't work, does it? So let's just try this again. 60,000 times 40% does not give you 48,000. It in fact gives you 24,000. Sorry about that, folks. I have problems with numbers. Good thing I don't use them for a living. So 60,000 less 24,000 does in fact give you $36,000 as the profit after tax. Okay, so the takeaway point from this analysis is that income tax operates as a variable cost. If you determine what the profit after tax value is, the target profit divided by the after tax rate, 1 minus the tax rate, that gives you the profit before tax necessary to achieve the after tax profit that you want. Okay, we have the profit before tax, and that amounts $60,000. Needs to be added to the fixed costs to attain our target. Okay, so contribution margin needs to cover fixed costs and the income necessary to give us the profit after tax. This is the target contribution margin, $348,000 that's necessary, and each unit gives us $6, and each unit or each dollar of sales contributes 30 cents toward the target contribution margin. So just for the sake of illustration, let's use this percentage column because the question is asking for dollar sales. So let's calculate the target sales which would be the target contribution margin divided by the contribution margin ratio or the contribution margin percent. The target contribution margin is $348,000 divided by 30%. That means that every dollar of sales contributes 30 cents to covering fixed costs and profit. So 348,000 divided by 30% means that the company must attain $1.16 million in sales in order to attain its target profit. Okay, let's check to see if this is appropriate. $1.16 million in sales times the cost percent of 70% yields $812,000 as the variable cost. Let's check to make sure the income statement works downhill also. $1,160,000 less $812,000 of variable costs. Okay, that does in fact give us this $348,000 target contribution margin. So the sales dollars that Wyatt Company must achieve in order to get $36,000 of target net income must be $1.16 million. If the company would want to know how many units it must sell, dividing 20 into $1.16 million would give it the break-even units or target units. So if we would take sales of $1,160,000 and divide it by 20 as our unit sales, $1,160,000 divided by 20, that would give us 58,000 units as the number of units it would need to break even. Okay, there you have it. That is the main thrust of Chapter 21, Cost, Volume, Profit. To review, the concept is that the contribution margin is the minimum amount necessary to cover fixed costs and profit. The tactic used to solve the problem, or any problem, would be to determine what your target profit is and work the income statement from the bottom up to calculate the target contribution margin. Once the target contribution margin is calculated, use either the unit contribution margin to determine the number of units necessary to reach the target amount, or use the percentage amount to determine the dollar sales to reach your target income amount. Thank you for listening. Give the problems a shot, and as always, please review the course calendar to see the exact problems that you need to do for this chapter. There is a Google upload for the discussion questions, and there is a Google upload for problem 21-6A. And please do not hesitate to contact me with any questions, observations that you have. Thank you.